Royce, ano batch mo?
Huh?
What batch are you?
I got batch 1. Lucky
Batch
guy.
one.
Let me share my screen. So this should be like medyo informal session naman talaga. The main goal is to really can you see my screen? Right. So we want to parang give a quick explanation lang for the sample valuation that we gave to you guys, for especially for those uh, who are unfamiliar with valuations, but also for those who are familiar, right? I think if you've seen the sample, iba right? It's not the DCF that you expect, because I'm sure the DCFs that you've seen in class, mahaba siya, and the DCF that we gave is fairly simple, right? It's just 2 tabs, right, of one sheet. So the parang what Edmund sent talaga was right. Like, you really have to keep it simple, because we're not trying to be precisely right naman here with valuations. We just want to get a sense um, of the business model that you've read from your deep dives, right? We want to turn it into something that, at least it's going to be useful to us, especially if like we're investing or like we're trading, right? So 90% of valuations is is on your revenues talaga. Right? That's the most important part of valuations. And what Edmunds uh, taught you guys with breaking down the revenues into price and quantity is the key ingredient in being able to achieve a meaningful revenue projection, right? So I guess before I get into this, for those who aren't familiar with Teledoc, right? Teledoc is a telehealth platform, and they offer a wide array of solutions for to be medically correct treatments, right? So from chronic care to mental health to even your day-to-day illnesses, right? They offer a oversight, medical oversight, right, and monitoring. So since 90% revenues, right? I only have one tab for revenues lang talaga. And the first step that I did was to segment the revenues into their different phases. So the main products are subscriptions. You guys hear me? I think I lagged.
Better.
Stop my video. Sorry. But did you hear what I've been saying? Or did I get
Not much.
where did I stop?
Sa revenues is one page. Tapos
Yeah.
putol.
Okay. So yeah, as I said, revenues are the most important part of valuations. 90% of your valuations would really stem from how good your revenue projections are, right? And what I did with revenues is to segregate each segment of the revenues. So for Teladoc, you have the subscription access fees and the visit fees. So those are the two most important parts, right? And to further uh, segregate it, right? I split it up into the quantity, which are the number of memberships, right? And the price, which is the average selling price per membership, right? And with this split, right, you can approach this in three ways, right? So either you project the quantity, project the price, or project both. Right? But it really depends on what you can project or cannot project, right? And here I have explanations as to why I projected both. So for the quantity, right? My explanation was that during the pandemic, a lot of your health systems, so for example, hospitals, your doctors, right, they would use off-the-shelf video conferencing products such as Zoom, right? But it's not that integrated. It's not that sustainable compared to being able to use a platform such as Teladoc. Right? And so with that, very simple explanation, I projected a huge growth in the quantity of memberships. So for 2021 to 2022, 50%, right? And then 30% for the next for the last 4 years in the forecast period, right? And this would be stemming from international expansion naman. And and so where did I get 50%, 30%, right? It's just it's just a random projection, to be honest. Right? It's more parang you don't really have to be precise on the exact number of memberships, right? It's really just a ballpark figure. Now, looking at how many hospitals, how many doctors aren't under Teladoc's platform yet, right? And then transforming it into this one. Right? And then I also projected the average selling price per membership, right? And the main reason for this is because Teladoc has pricing power. And so that's really important to note because in the next segment, I didn't forecast or I didn't uh, project the average selling price, right? Because they don't have pricing power for this segment. So it really depends on your analysis based on your deep dives of your company, right? So going back, right? Teladoc has pricing power. So I gave them a conservative projection with their average price. So 20%, 50%, and then 10% for the next 3 years, respectively. And then 2% inflation lang yan. So very simple, right? And then if we move on to the next segment, it's the same. So separated it into the quantity, which are the visits, and the average selling price per visit. Right. But this one, I further segregated this, or further broke it down to the number of patients and the visits per patient, right? To arrive at the quantity. So my thesis here was that Teladoc has a large untapped market in terms of their chronic care solutions. And And most of the population, right, isn't being serviced yet with chronic care oversight, chronic care monitoring, right? Which is very uh, which is life changing, I would say, because what they do, what Teledoc does is that they give you medical tools for you to monitor like your heart rate, your blood pressure, uh, those stuff, right? And then they and then the doctor would be able to like monitor like your health status, right? And a small shift in that can be life changing, right? Because the doctor would be able to quickly identify if something's going wrong, right? And most of the U.S. population with chronic health diseases aren't subscribed to that yet. And so I aggressively projected the number of patients in their visits, right? Knowing that there is a large untapped market for chronic care, right? But the reason why, as I said before, why I only projected the quantity here is because Teladoc doesn't have any pricing power here, or at least not yet, right? Uh, it's a hard, parang, it's hard to increase your prices for this one, especially since the service that you will be getting from the start to how many years later would be the same lang naman. Right? There's no change in the quality of service. There should be no change in the quality of service, right? So the price, I retained it. Right? And then yeah, that's basically it. Um, and then I guess parang the last way you can project your revenues for so if you I don't know if you've seen an earnings call or if you know what's an earnings call is, right? But usually during annual reports or quarterly reports, companies would discuss their numbers to their shareholders. This is what we call an earnings conference call. And in one of Telenoc's conference calls, they discussed about uh, healthcare data, right? And distributing that data to like key uh, suppliers, so such as like your advertisers, your pharmaceuticals, ganun, right? And so because Teladoc doesn't have that segment yet in their revenues, what I did was I took the total addressable market of healthcare data, right, and then got a median uh, a median amount of 69 billion. And then what I did, I just gave Teladoc a conservative market share of 2%, right? And then, and yeah, like, and then that's basically their revenue for that segment, right? And then, and once you have your revenues, right, it's very simple from this point onwards. So for the gross profits, what I did instead of projecting your costs, right, which is I think what you usually do, right? I projected their gross margins na lang because it's essentially the same, right? So I gave them a stable gross margin for the projected period at 65%, because assuming 2020 was the the high base, right? Because that was when most of the uh, clients came in, right? So they should be stabilizing from that point on. So 65%. And then you arrive at your EBIT from, again, projecting EBIT margins, right? The same case. And then from there, uh, tax is straightforward, right? And then you get the FTFF. I didn't bother with the other accounts like depreciation, capex, and net working capital, because it's not really that significant, right? There's no, it's the difference in what the end value that you get is minor if you project this. So I didn't bother projecting it now. Right? And then yeah, and then the other part of the valuation, right, which is getting to your DCF now. So the first step for that is to be able to arrive at your WACC. For those who aren't familiar, it's the weighted average cost of capital, right? Basically, you take the average cost of capital for your debt and equity, right? And then you add it. So for debt, uh, it's the debt ratio, which is the weight of debt times interest rate, which is the interest rate of the company's bonds or debt, right? So that's your cost of debt, and then the tax rate. So the formula's here, right? And then you just plug it in right here. And then the same for equity, right? Equity is basically the CAPM, or the capital asset pricing model, right? So again, you have the weight of equity, which is from the weight of debt. So 1 minus the weight of debt, right? And then multiply it to risk-free rate. The risk-free rate should be the US Treasury 10-year bond. And then the beta you can get from like different sources, like Reuters, Bloomberg, I think has. Right? And then the risk premium, right? So the risk premium comes from uh, the expected return of the market minus the risk-free rate. So I think the expected return of the market last year was around 6.5%. And then you subtract that to the risk-free rate, you arrive at 4.5%. So it's basically your WACC portion. And then with that, like just have to discount the forecasted cash flows to the present value, and then you just apply the usual DCF stuff to arrive at the price per share. Did you guys get it? Was I too fast? Gets nyo pala eh.
Sorry,
If no
wait.
one's asking.
The
Okay, go ahead.
Can you repeat the part where you were basically doing the formula lang, as in for debt portion and equity portion? Like which ones? Yeah, like basically how you get to the WACC and how you get to the NPV of,
Okay,
yeah.
okay.
So sorry.
So debt and so the debt you get from uh, the financial statement, right? So you add short-term debt plus long-term debt, right? Total debt isn't gonna be the total liability account. It's a short-term debt plus long-term debt lang. And then the total equity, it can be your equity account na, the total equity account, right? And then you just for the weight of debt, it's just debt over the sum of debt, the total debt and total equity. So that's how you arrive at the weight of debt. And then the weight of equity is just one minus that, right? For interest rate, that would be, I guess, the average interest rate of the company's debt, right? So when you borrow money, there's an interest rate. So that's basically the interest rate, right? Or the average interest rate of the company's debt. And then tax rate is just the US tax rate this time at least. So you get the that portion naman.
Yeah, I got that. Thanks.
And then for equity portion, so it can also be named as the CAPM model, capital asset pricing model. And the formula for that is the weight of debt times risk-free rate plus the beta times times equity risk premium. Right. So again, the risk-free rate would come from the US 10-year treasury bond. At least that's the standard benchmark for risk-free rate. Right. And then beta, levered beta, would come from you can just search it. So Reuters or Bloomberg would have that data for you. But if you can't find parang an amount for your specific company, right? Usually we do 1.5 or 2. So and that would depend if it's a mature company, mature growth or high growth. Give it a 1.5 and then young growth, ganun. Startup, we give it a 2. But if it's really early in its business life cycle, we give it a 2.5 or 3. Right? So that's if you're not able to find data for this long. Right? And then the risk premium, it, so ERP, it's also equal to the expected return of the market minus the risk-free rate. Right? So the expected return of the market would be the expected return of the S&P 500 for the year. So last year was, I guess, around 6.5 to 7. Right? And from there, you subtract the risk-free rate that you got to arrive at the equity risk-free. And then with the NPV, right? So you have the terminal value, right? So you multiply hello.
Yeah, we hear you.
Oh, okay, sorry. End up lagging out again. Yeah. Basic I guess what you can do para mas madali is to give it a a discount rate. Right. So this would so the actuals would be 1. And then the projected would be 1 over 1 plus the WACC. Right. That would be your discount rate. Which so sorry. Right. Raised to so this would be the discount rate of each of the year for your cash flows. And then from there you just multiply it. Right. To arrive at the discounted cash flow. Okay. Yung discount rate, it's 1 over 1 plus the WACC, right? Raised to how many years in the future? That specific period. So for 2021, that's 1. And then 2022, that's 2 years, 3, 4, 5, 6, so on. Right. And then that's basically your discounted cash flows. And then from there, you just have to
regardless, i-estimate mo pa rin kung
sum this up
ano yung magiging scope natin to support your full functional.
to get the net present value. Gets
Wala
ba?
bang
Okay, got it. Thank you.
Okay. You guys have any questions? Because I know this was a lot.
Question because I haven't had my finance class yet. Why do you add again, including the previous years?
Can you repeat that?
So pwede natin
Why do you add from 2016 to 2026? It's not pala like future only.
Oh yeah, future. It's the 2021 to 2026 lang for the future cash flows.
Okay, so you only add the future.
Yeah, if you're projecting.
For the WACC, like do you just add the debt portion and the equity portion, or
Yes,
do you?
yes.
Okay,
You add it.
them?
So you add it.
para mas maging flexible tayo.
If ever, last question, will you explain pa the ones
Ikaw sinabi naman niya, di ba, na kahit na nag-MCL, parang
The ones below. Okay.
tama ba? Kasi sinabi niya, di ba, yung
So,
is i-re-retain.
What we did here was simply placed a multiple and just multiplied it to the value that we got from our projections, right? So there's 2 multiples that are important. So that's the P ratio and the PS ratio, right? Usually we use the PS ratio for companies that aren't earning yet, right? So for example, Teladoc hasn't netted an income yet. And as you can see, even in my forecasts, the first 2 years are actually net loss per year, right? And so you can use the price of sales method if your company's not netting an income yet. But if your company is netting an income or is expected to net an income, you can use the price to earnings multiple, right? To arrive at the price per share. And so what we did here was to basically multiply so the future value, which is the terminal value of 1644, right, by the multiple, which is 25. So I did two multiples just to give a range, right? So 25 and 50. But then multiplied it to arrive at a future value of that multiple. And then I discounted this terminal value, right, with the WACC. So I arrived at a present value of 25 billion and 50 billion, right? And then from there, you have to take or you have to get your equity value to arrive at the price per share or your projected price per share. And the way to do this from your enterprise value, right? So the enterprise value would be the present value of the terminal value, right? And then add it to the net present value of your cash flows. And then you have to add the net debt. So the net debt would be the total debt, same total debt for the debt portion, right? And then subtract it to cash. Your cash account, you can find it in your balance sheet. So that would be your net debt portion. And then from there, after you arrive at the enterprise value, you basically take out the net debt again to arrive at the equity value, right? Because for those who aren't familiar, enterprise value is the sum of the market value of debt plus the market value of equity. The market value of equity can also have a different name, which is market capitalization. That's the usual name that you see like in stock reports, right? So market value of equity is the same as market capitalization. And so after you get equity value, you divide the number by the outstanding shares of the company, right? Outstanding shares, you can find it in the financial statements, right? Or you can get the market capitalization of the company and then divide it by the price of that the company is trading at. So for example, this is not accurate pala. But let's say today Teladoc's trading at $198.77 and its current market cap is, I believe this is 30 billion, right? And so dividing the market cap by the price, now you arrive at the outstanding shares. And from there, you divide that, you arrive at the price per share. Yeah, the price per share. Marco, you have a question.
So I have two questions lang. So for the terminal value, is it better to use the relative? Like when do we use PE or PS compared to like Gordon growth model or perpetual growth models?
So basically here we're just keeping it simple with using a multiple model, right? You can use, if you want to use the DCF, the usual DCF, you just have to add the NPV and the present value of the terminal, right? Present value of the terminal. And then that's basically your equity value, diba? After you take out the net debt.
Sa contract na yun.
But that's your usual DCF. Right? There's really not much. Well, I mean, it's different, but it's really up to you on what you want to use. Right. The reason why we're doing a multiple model also is because we're basically saying that Teladoc would be like your Facebook, your Amazon, like in the future. That's why we gave it a high multiple also.
And then for the outstanding share count, do we also need to get diluted outstanding share count?
Tapos bayaran nila tayo
No, no, no.
for deployment.
Just the normal outstanding shares.
Okay, thank you.
Arvin, you have a question?
Yeah, so basic question lang, because I don't have finance yet. What's the terminal value? It's the last
So it's the
of
final year, yeah. It's the final year of your forecast period.
okay, yes. How about the 25 and 50? Like I understand we want like we're forecasting they're gonna be a good company, but then is there some basis to 25 and 50, or is that like standard for good companies?
That's a good question. But usually for good companies, that this would range a bit lower, so around 10 or 15 to 25, right? The reason why we have 25 to 50 is because Teladoc's still growing, right? And at least for within the forecast period, uh, we see it continuing to grow. That's why the multiple is high, right? There's a premium in the multiple. But in your case, what you can do is uh, you can look at like what analysts are projecting. So, for example, if your company is Apple and and you're not sure of the multiple that you want to apply, you can look at what analysts are saying, or the multiple that analysts are projecting for Apple, right? I can, if for all of you who need that value, I can extract that naman to help you guys with your evaluation. Just, yeah, it's hard to slap on a multiple randomly because this largely affect uh largely affects the price per share that you will arrive at.
Follow-up question, sir. So if ever, how would you do like a sensitivity analysis? Kasi parang everything can be, yeah, everything's like can be change naman? Like where would you mostly
Pwede natin
attribute
palitan.
that sensitivity analysis?
1 year pa lang,
Well,
dapat sila ay magaling shoulder nila.
to be honest, we don't do sensitivity analysis kasi. But are you saying something?
Oh, can I ask why, sir? Or is it generally not that useful talaga?
It's not that it's not useful, right? It's just that we like to keep our model simple, right? And stick to the model. I mean, of course, usually sensitivity analysis would come with the really long discounted cash flow models, right? I guess the models that you're used to seeing in schools. That would be useful. But in our case, because we're trying to keep it simple,
Pero wala yung sa original contract, alam ko.
parang counterintuitive if we do a sensitivity analysis pa. Because that complicates a lot of things. Right? Because you're gonna arrive at a lot of other values. But I mean, it's up to you if you want to do it. Right?
Follow-up question, sir, because I've never had this class yet. So what did you not include from a regular school complex DCF? And then what would you say are the advantages and the disadvantages?
Okay. Let me share a new model. So can you guys see it? So I think I made this model 2 years ago, right? And as you can see, there's a lot of tabs. So the main tabs are the 3 financial statements. So that's what you're gonna see. The sales. So these are just broken down into a lot of other sheets. The ratios, the debt portion, the working capital, the PPE, and then you have the DCF, of course, and then forecasted inflation and stuff. Actually, not much different. I can, if you want, actually, I'll just do it. Right. So what I'll do here is I'll do the simple so I'll do the valuation that I did with Teladoc, right? So I made another copy. I'm gonna remove all of these, right? Because we didn't have that in our Teladoc. Right. And then let's see how close the target prices would be. Okay. So revenues. That's revenues. And then we won't bother with the gross profits na kasi we'll use gross operating margins naman. So these are the actual margins for actual years. And then we'll project the margins for the forecast period. So let's highlight this now. So let's put, I guess, 10%, 10.5%. 10.5%. Drag it. Multiply. And then taxes. Let's check the effective tax rate for URC. 20%. So multiply this Multiply,
Posting
multiply
na
the
tayo.
operating profit at 20%.
Hindi ko alam. Siyempre, all in na eh. Isa-isa. Pwede natin isa-isa eh. Kung gusto natin.
And then subtract operating profit or EBIT, taxes. And you arrive at 125.68, right? And then the normal DCF,
Kailangan bawasan ng
127.07. So there's really not much difference if you do the long or the short way, right? It's just 2 pesos, 1 point something pesos, right? I mean, if you're asked, like, if you're working as an analyst and you're asked to do a DCF, obviously you have to do the full thing, right? But for our purposes, we want to keep it simple because
fixed fee na terminal na.
we're not gonna focus too much on the ano rin naman eh, the full fundamental foundation of the company. I guess the advantages for the full DCF would be that you'd really be able to analyze each account. So whether it be the debt, right, the working capital, the capital expenditures, but if you're not gonna go into those accounts naman, then just do the simple, just do the simple DCF, like what we did for Talaga. Because basically arrive at the same price naman eh, the same target price, right? So yeah. If you guys want this, I can send it also. But this is old, so it won't be accurate. But at least the models should be same naman. Any other question? Okay, Marco. Again.
I was just curious because I saw like in one of the tabs there was a percentage of net income to non-controlling interests. For you, how do you take into consideration NCIs? Like, do you just subtract the NCI balance from the enterprise value when you use DCF?
Well, that's what I didn't really mind it because it's just it's neglectable naman.
But for
So
total,
it, I guess it would depend on the stake of the company on its uh, subsidiaries, right? So it depends how significant or how many it has, right? But for your C's case, not much naman eh. So
but if it's like significant, how do we take that into consideration? If it's like a like half, let's say, of the net income.
then what you can do is you do the usual per rin, right? Just to para not overthink it. Right? Because I mean, I don't think ano naman eh, like it'll change unless management says something explicitly about that, right? About their subsidiaries. But in any case, it should be ano naman eh, the same. So just retain it.
Thank you.
Alvin, you have another question.
Yes, sir. So, how long does it usually take to make the simple one and the complex one?
The simple one should be around 1 to 2 days. The complex one, 2 to 3 days. Right. But the 2 to 3 days, this one I think I did what 40 hours, so pretty long. because there's a lot of other things that you have to do, like the balancing of the financial statements, right? And then the write-up is usually longer for this because you have a lot of other components. But for the simple one, right? Because you only focus on the revenues, which is like again 90% of the work. Uh, it should be fast, so it could take a day, and then the next day for the write-up, right? Because revenues lang talaga focus mo, which is the pinaka story of the company, right? It's like your deep dive that you put into words, right? So that's basically it.
Follow-up question, sir. What would make this obsolete? Like, for example, with an earnings report next quarter, and then parang, oh, your forecast was like a growth of 15%, but then it became 5% lang. So, yeah, I guess my question is, what type of news or outcome would make this kind of obsolete, or generally none naman within the first few years?
Well, for me, why I do valuations is just to be able to keep a mental model of the company. Right? For example, because diba, you've done your deep dive, you did the valuation, right? So you fairly know everything about the company. And what you're looking for in the next few years is whether they would be able to execute. Right? And that's through their quarterly reports and their annual reports. Right? And so when something such as a projected 15% drops to 5% actual, right? And the madaling ano na yun, right? There's an easy conclusion from that na, right? And then from there, would you drop out of the investment, or would you drop out, or would you not trade it at all, right? So very straightforward from that point. So you can adjust again the valuation, but at that point, right, with such a significant drop, especially if it's on the revenue end, um, it's medyo sira na yung story. Right? And so, just that's why we want to keep it simple. Right? Where we can just, so once we hear of the earnings, it's fast to register na. Right? We don't have to think too much about it also.
Yeah. Last follow-up question regarding that, sir. So, what's an acceptable range of parang underperformance?
Well, that's hard because it might be relative. Right? That's why you have to read into the management's discussion of why the revenues drop, right? If it's something systematic or unforeseen, then it can be acceptable, but from there you should reevaluate the company na. Yeah.
Thank you, sir.
Harold, do you have a question?
Okay. My question lang is, since dun sa simplified, we removed the PPE section. So, pag yung company is PPE heavy, will that be a big factor?
Yeah, it can be. It can be.
So, pagka ganun, how do we forecast yung PPE sa simplified version?
Well, you just have to add a PPE tab. And then for each of their, well, you don't have to do for each naman. You can do the most significant PPE and then just forecast that one.
Okay.
But that on that end, you have to be cautious, especially on what management says. Right? I mean, if they don't have plans on expanding, right, or selling that asset, you don't really have to do that much on that end also.
Okay.
So it really depends. Right. So let's say if Tesla would be building new factories, then that's pretty significant. So
Okay.
any other questions? Okay, okay.
Sir, yeah, another question. Super simple, but then why 5 years, sir? Like, do we do that just because it's the standard, or is there like some reason, like why not 6, why not 10? Or
So that's a good question. Right? Usually, I guess not to complicate it, it would depend on the life cycle, the business life cycle of the business. Right? So, for example, a startup, young growth company, right? Yung the so for example, a company like uh what's this startup young growth company? Let's say 3D printing, like 5 years ago. 3D printing 5 years ago was not viable yet because of its cost, right? And so if I was gonna do a valuation on a 3D printing company 5 years ago, I would project it 10 years because its product would reach adoption in 10 years, right? Meaning the revenues and the earnings would materialize uh, better after 10 years compared to 3 years, compared to 5 years. So it depends on your judgment on uh, when the company would be able to, uh, I guess, stabilize on the revenue and earnings end. Right? So for Teladoc, right, if I go back to Teladoc, um, I did 6 years, right? And if I did three, it's medyo pangit kasi the earnings end is just starting to turn around. Right? So I put a little bit more years, right, just to see its stabilization. So it really depends.
sorry, sir, is there like a standard for small startup companies? You should do 5 years. For mature, you should do 10 years, or wala naman?
Wala naman. Yeah, it's really up to you. But of course, that would significantly affect your valuations also. Right? Because a startup company in 2 years, a lot of things can happen. Right? Because a startup in nature is very uncertain. So 2 years might be unfair for the startup.
For the revenue, sir, do you just count it per business segment, or like how about for businesses with more diverse product lines? How would you calculate the revenue, or do you just do it per business segment?
But that's basically it, like per business segment.
Thank you, sir.
Any other questions? If you guys need help, just ask your mentors, especially with evaluations. Right? Because it's really hard to get it the first time talaga. Right? When I started naman, this wasn't how I did my evaluations. It was kalat also. So just ask. Right? because you'll pick it up faster if you ask. So, any other questions? I guess that's it. Jordan, Sheena. Jordan. But have you guys started on your evaluations, diba?
Not yet.
It's okay.
I
We're
don't
not
think
we're not that strict naman on the deadlines, to be honest. Right. But I mean, if you pass, at least we'll be able to give feedback, right?
Pero honestly naman, I think yung heavy work more is on the deep dive. Tapos parang
Yeah, yeah,
value niya,
exactly.
parang
Kaya,
putting it into numbers lahat ng nabasa mo eh.
yeah.
So yung important yung matagal is yun na ba, yung pagbabasa naman.
Yeah.
Uh,
And they've read the company well, eh. Like,
hmm,
I've looked at the deep dives naman.
Nice.
Yeah. It's fairly complete. So, I mean, I guess mahirap lang talaga yung ano eh, turning it into numbers.
hmm.
Right? But like, our motto here is we'd rather be like widely right than accurate than precisely wrong. Right? You get that? Because at the end of the day, who knows what the real price would be? Right? Even analysts don't end up on a like analysts would have different projections rin eh.
Kaya nga minsan nakikita mo analysts like sobrang laki rin naman range nila eh. It's perspective ng tao.
Yeah.
Malalaman mo na lang pag nangyari na. So as of that moment, it's just like a wide range at the end of the day.
Mhm.
Okay na? I think
Last question.
Yeah, go lang.
Yeah, so parang analysts, they could have a wide range. So would the possible way be just average those 5 analysts, and then that would be your quote unquote target price, na? Or is that like a bad idea?
I mean, if you're not doing the valuation, that's okay, right? At least you get the sense of like the expectation for that stock, right? So let's say the recent one that I checked was Rakuten. If you're not familiar, it's a Japanese company. So Rakuten, what's its current price? Let me check. Its current price is at 1,300 yen, and one analyst projected it to around 35 yen. Right. So from my end, parang at least parang they're seeing something that I don't see. Right. Maybe I don't understand the company that well. That's why they're giving it such a high target price. But I'm not necessarily holding the company until C5, right? But on my end, my expectation is that, okay, there's something happening good in the company, which is why this analyst gave it such a high target price. And so I can expect it to at least rally in the next week, month, how many months or so. Not necessarily holding it until C5, right? But at least the expectation is there. Right? And I think the same for your valuations naman eh. Right? If you have a like 20-50% disparity, right? There's a sense of expectation setting. Right? So if 20% lang, would you bother getting that 20% versus 50%, right? Not necessarily going for that specific target price, but just your expectation. yeah, I guess that's it for now. If you have any other questions, you can ask your mentors or ask your mentors to ask me. Or
Yeah.
just
As you do it naman, tsaka nyo mafe-feel yung questions eh. Siyempre right now, ang hirap mag-isip from on top of your head. So wag lang kayo message lang kayo sa group chat. Kung nahihiya pa kayo, PM nyo kung gusto nyo, okay lang. Yeah. Tama naman. Like,
or ask in the bigger group chat para
Yeah.
at least everyone can see.
yeah,
Everyone can see.
yun nga. Yeah, that's it. I think.
Yeah.
For coming, guys.
Thank you. Good luck with your
Good luck sa bahay.
evaluations.
Thank you,
Yeah,
Lance.
tapos ano rin, kung gusto nyo after nyo mag-upload, pwede nyo PM agad yung mentor nyo, tanungin nyo like comments about it. Para, yeah, para mabantayan. Hindi man kailangan like deadline bago